So in the previous session, we had seen national income accounting, the concepts like GDP, GNP, NDP, NNP, so on and so forth. In today's session, we will be moving ahead and we will be focusing on banking in India. We'll understand certain concepts related to banking in India, the important concepts, and then we'll look into the questions of banking in India. Right. Now, please understand that banking in India is one of the most important topics in Indian economy. Almost 1/3 of the questions come from banking in India. In the last 13 years, there have been total 193 questions in the Indian economy, and around 63 questions have been from banking in India, which is close to 1/3 of the questions. So it holds a lot of importance. What we'll do is understand the important concepts related to banking in India and then keep solving the questions that have been asked previously. So these concepts will help us answer those questions. And also at times some questions which we will be answering we may come across some new concepts also, some different concepts also. So as and when we solve that, we will understand those concepts as well. So welcome to Legacy IAS, and let's get started with the revision for UPSC Prelims 2024. So banking in India. First things first, why the need of the banks? The need of the bank, if you want to understand, go back to history. Historically, why would there be a need of bank? When human beings were there on the earth, we were hunter-gatherers, hunting and gathering food, that's it. Afterwards, when we settled down a bit, there was farming which started, but that farming was like a subsistence farming. Meaning, whatever I want, I am growing only that much, that is it, nothing more, nothing less. But after a while, when efficiency increased in production of agriculture, then there was a surplus. Surplus started happening. When there is a surplus, I have certain additional thing. So now when I have certain additional thing, what will I do with that? I will exchange that with you. For what? For something additional that you have. So initially, what was there was the barter system. In barter system, goods were exchanged. So let's say I have additional rice, you have additional wheat, I give you X amount of rice, you give me Y amount of wheat. Correct? But what's the problem in this? The problem in this is, I should want what you have additional, and you should want what I have additional. So this transaction can only happen when you want rice which I have additionally and when I want wheat which you have additionally. Just take for example, if I want wheat and you have wheat, but you do not want rice, you want jawar. So will you exchange with me? Of course not. So at the same time, if let's say you want rice, I have additional rice, but I don't want wheat, I want vegetables. So will I exchange with you? Absolutely not. So when the exchange will happen? Only when I want wheat and you have additional wheat, and I have additional rice and you want additional rice. So I should want what you additionally have, you should want what I additionally have. This is known as the double coincidence of demand. The double coincidence of demand needs to be there. If this double coincidence of demand is not there, there will be a problem. So this problem we faced, and once we face this problem, how do we resolve this problem? By bank? No, not banks yet. This problem, guys, would be resolved by the concept of one particular thing, which probably is the most important thing, arguably the most important thing in the world, and that is the concept of money. So what is money? Money is the medium of exchange. Medium of exchange. You use it for exchange. Now how does money solve the problem of the issue of barter system of double coincidence of demand? I have additional rice. You have additional wheat. Now I want wheat from you, but you don't want rice from me. So what I do, instead of giving you rice, I give you money. and I take your wheat. Now the transaction will go ahead. Why? Because now you have money. And let's say you did not want rice, you wanted vegetables. So what you can do is you can preserve that money with you, and whenever you come across a vegetable vendor, a vegetable trader, you can give the money to the vegetable trader and get the vegetables from them. Hence, money as a medium of exchange has solved the problem of the barter system. Now, we have still not come across the reason as to why banks have come into existence. So we saw that the money has solved the barter system issue. But then why the banks came into existence? That is because, let's say if I want to buy a house right now, I do not have enough amount of money. But I know every month I earn a lot of amount, so that if I save for 15 years, I can buy a house. But then I'll have to wait for 15 years. So that's when banks come into the picture. Bank says, Toha, you don't have to wait for 15 years. What we can do is, we will give you loan. We will give you the loan. You take the loan, you buy the house and keep paying us installments. Right? So now this loan, please understand this, that this loan I could have taken from someone else also. Let's say my friend, that would be from the informal sector. An earlier informal sector of lending was there before the banks came in. But the problem is, I may have a friend who's ready to give me the loan and I will return it to them, but at times I may not have a friend who's ready to give. In my friend circle, maybe no one has money, or even if they have money, they don't have trust that I will return XYZ reasons. It can so happen that I just crossed a person on the street and that person has additional money, but I don't know them, so that person cannot give me money, right? So the bank would connect me with that person, not directly, indirectly. I'll tell you how. Let's say for example, there is Miss X. There is Miss X who wants loan, money. There is Miss Y who has surplus money. Now Miss X does not know Miss Y. So she cannot ask for money, and even if she does, Miss Y will not know any background, any detail or anything. How will she give the money? So what happens is, Miss Y has surplus money. She invests that as fixed deposit in the bank. Now the bank has Miss Y's money. And now Miss X comes to the bank for asking for loan. So this Miss Y's money, the bank gives as loan to Miss X. How the bank is able to trust? Because the bank is going to ask you for your pay slip, for your Aadhaar card, identification, address proof, undertaking. They will give you certain things and ensure that yes, you are capable enough to repay, so I can give you the loan. So they will give the loan to you. So the bank is acting as an intermediary. The bank acts as an intermediary over here. Now, why would the bank do that? Can you think of the reason as to why the banks would be ready to do that? Because banks also should have certain motives to do that. The motives that the bank has over here is profit. So how will they earn profit? It's very simple to earn profit. What they'll do is, remember Miss Y has kept certain additional money with the bank as, let's say, fixed deposit. So the bank will give Miss Y the fixed deposit she has kept. They will give her, let's say, 7% of interest. And Miss X, who has taken a loan, that loan will be given to Miss X at 14%. So what is the difference? The difference is of 7%. And now this 7% is the revenue that the banks will generate. 14 minus 7 gives you 7%. From this 7%, all the cost, implementation, management cost, employee salary, everything will come out. Plus also the fact that if 100 people are taking loan, all 100 people will not return the loan. So some losses will also be there. That will also be accounted for here. Plus certain profits of the bank. So this 7% will have all these things included in that. Now, there is another thing. That is that the bank need not necessarily give the loans from the money which the depositors have deposited in the bank. Okay, so how else can they do that? what they can instead do is, instead of Miss Y, they will take the fixed deposit from Miss Y also. It's not that they will say no to her. But if the banks want more money to give it as loans, then what will the banks do? The banks can also go to the RBI and get money from the RBI, right, for giving more loans. Now when the banks go to the RBI for getting more money from the RBI will also not give money at free. RBI will also charge some interest rate, and that interest rate is repo rate. We'll study it later. So RBI will also charge certain interest rate. That interest rate is, let's say, 7.5% or 6%, something or the other. So at this percent, the bank will get the loan from the RBI, and after further calculation of the cost of the cost, for example, and at the same time, if you give loan, some may not give it back, plus profits. After doing all that, they will again come up with certain interest rate, let's say 13 or 14 or 15%, at which they will be giving loan to Miss X or someone else. So what is the source of money which the bank gets for giving out loans? Either the people giving fixed deposit or the RBI is also a source of money. So at the same time, if banks are in dire need of money, their liquidity issue is there. So RBI again at that time can provide money to the bank, and since RBI is the one providing money to the bank, RBI is also known as the bank of last resort. When the banks do not understand, do not have money, do not know what to do and from where to get money, they can reach out to the RBI, and in such situation RBI provides money to this bank. And since that's the last option for the bank which is being addressed by the RBI, RBI is known as the lender of last resort. When no one can help out the bank, it's the RBI that is going to help out the bank, and hence RBI is known as the lender of last resort. In addition to this, RBI is also the regulator of the banking system. Meaning it is regulating the banks. Okay, it is regulating the banks. I hope that's clear. Now, why the need of bank? It is clear. What are banks? It is an intermediary. It is clear. What are the types of bank? There can be scheduled banks and there can be non-scheduled banks. What is the difference between scheduled and non-scheduled? Scheduled banks are mentioned in the schedule of the RBI Act 1934. These banks are not mentioned in it. Okay, sorry. These banks are not mentioned. These banks are mentioned in the schedule of the RBI Act. Now, what are the functions of the bank? The functions of the bank is to give loans, give credits, allow people to deposit money, have various other instruments, provide credit card, provide debit card, provide internet. Now all those digitization and all is also there. So provide internet banking system, debit card, checks, demand drafts, DDs, now net banking, etc., etc., and various other instruments, financial instruments are provided by the banks. Now, as I said that RBI, the function of RBI is also to regulate the banks, right? So how will RBI regulate the banks? RBI will regulate the banks with the help of certain instruments. Now what regulation is actually required? The kind of regulation required here is very simple. Very simple as in very straightforward, not that simple as such. See, let's say bank has rupees 100 as fixed deposit. And the bank also has another rupees 100 as demand deposit. So first things first, the bank cannot use this 100 rupees because this is demand deposit. Demand deposit means As and when the consumer or the customer wants the money back, the bank has to pay them back. So this money you cannot utilize to give loans. This money you can utilize to give loans, the fixed deposit one, but not completely. Why? Because if you know that if you open a fixed deposit in any bank, let's say for 5 years, after 5 years it will mature, you will get the benefits, the interest and everything, but you can break that fixed deposit also. The bank may charge certain amount of penalty and may not give you the interest that is earned, or give you lesser amount and charge a penalty and then return the remaining amount. So some of them would break the fixed deposit also. That means you cannot give this money completely as loan, and you cannot give this money as loan at all, and you cannot give this money as loan completely. To some extent yes, to some extent you cannot. To some extent you have to safeguard. Right. So our interest is in this. This to you anyhow cannot give. This some amount you can give. Now what is that some amount is nothing but decided by the RBI. How is that decided? Let us see. It is decided with the help of CRR and SLR. So the RBI would ask you to keep certain amount of money aside so that you don't end up giving the entire loan. Right. But now the problem is, if I have 100 rupees to give loan to, you ask me to keep 10 rupees aside. If I keep that 10 rupees aside with me only, the problem is after some time when I exhaust 90 rupees and someone wants more 10 rupees loan, I may end up giving them. So keeping that money aside with the bank is not necessarily the answer. Another thing need to be done here. What is that? The RBI would then ask me as a bank to keep my money not with myself but with the RBI only. So when a bank keeps its money, a part of its money with the RBI, that money is the cash reserve ratio. So what is cash reserve ratio? The amount kept by bank with the RBI. That is cash reserve ratio. So what is statutory liquidity ratio? Similar but slightly different. Amount kept aside by bank with itself. So some of the trust RBI has in bank by asking them to keep certain amount of money aside by themselves only, but some amount they need to keep aside with the Reserve Bank of India for more assurity. So this is CRR, this is SLR, this is how the banks are regulated by the RBI. What is capital adequacy ratio? Capital adequacy ratio is nothing but the amount of capital that you have to address any risk that you may be having. The banks develop a lot of capital, a lot of assets, right? But at the same time the bank gives a lot of loans. Some of the loans may not come back, so that's a risk also. So how much capital do you have? Up to what limit can the capital which you have can address the risk that is there is your capital adequacy ratio. Higher the capital and lower the risk, higher will be the capital adequacy ratio. Lower the capital and higher the risk, lower will be the capital adequacy ratio. So it is nothing but the capital you have divided by the risk you are facing. Okay, so if the capital is 100, risk is 10, your capital adequacy ratio is 10. So your bank is very much capable to address its risk. In fact, it can address the risk 10 times. If your capital is 1, risk is 10, you can address only 0.1. You can address only 0.1 times. That means only 10% of the risk you can address. So this is an issue, right? This is a good situation. So that is what is meant by capital adequacy ratio. Now coming on to repo rate and reverse repo rate. Repo rate is nothing but, remember I said the banks can borrow money from the Reserve Bank of India also. So repo rate is the rate at which the RBI lends money to the banks. That is your repo rate. Now, why is RBI lending money? Because these banks want it, because these banks are short on the money and they want to give more loans, so they want more money. They go to the RBI and get the money at an interest rate which is known as the repo rate. But it can also happen that, let's say, a bank has a lot of money with them and no one is ready to take loans from them. In such scenario, what will the banks do? In such a scenario, the banks will also want to earn some money with the money they already have. If they keep it with themselves, the money will not grow. Right, the value will keep on going down due to inflation. So if banks have additional money and no one is ready to take the loan, so what they'll do, some amount of money they will keep it with the RBI. When they keep this money with the RBI, RBI will give them some interest rate. The interest rate which the RBI gives to the bank, when the bank park their additional money with RBI, that interest rate is your reverse repo rate. So reverse repo rate is interest given by RBI to the bank when the banks park their money with RBI. Clear? So that is your reverse repo rate. Now, having said that, let's move on to the questions. Whatever concepts we have understood, based on that we'll be able to solve a lot of questions. Some of the concepts may come in as new, and as and when they come in the questions, we will ensure that we understand those concepts as well. Alright, so let's get started. The very first question says, which one of the following activities of the Reserve Bank of India is considered to be a part of sterilization? Now let's understand the concept of sterilization. What is sterilization? Sterilization is nothing but managing the inflow and outflow of money. If there is too much money in the market, the RBI would try to suck it out. If there is too less money in the market, the RBI would like to pump it up. Managing the inflow and outflow of the money, or the presence of money in the market, is nothing but to manage that, you need to do sterilization operation at times. Right, having understood this concept, let us now see what the correct answer would be. We can get to the correct answer just by mere elimination. Regulating the functions of NBFCs, non-banking financial institutions? No, it is nothing near the management of inflow and outflow. Debt and cash management of the central government? No, this is rather the concept of financial management. It is like the activity of a chartered accountant. The chartered accountant, what they do? They manage the asset and liability of an individual, of a firm. So when that is being done for, let's say, the government, again the operation is same. This is also not. Oversight of settlement and payment system. What is settlement and payment system? Whenever I pay through UPI, net banking, the payment gets settled. Now having an oversight on that is nothing but an oversight or regulation or monitoring operation, which is again not related to sterilization. So this is also wrong. Now there is only last option, conducting open market operations. Yes, this, guys, is sterilization. Why this is sterilization? Let's take an example of an open market operation. Let's say that there is a too much rupee in the market, because of which there is high inflation. RBI needs to carry out sterilization operation in order to reduce inflation. So what the RBI would want to do? Suck out rupee from the market. How can the RBI suck out rupee from the market? By selling government securities. So the RBI will sell government security. Government security is nothing but a piece of paper which the RBI will give to the public and take money from them. So when RBI is giving paper to them and taking money from them, RBI is basically sucking out money. That is one of the open market operation which is a part of sterilization. I hope that is absolutely clear. Moving ahead, Which of the following is not included in the assets, of a commercial bank in India? Option A, advances. Advances are included. What are advances? When a bank is giving loan to you, bank is giving advances to you. Now that is an asset. Why it is an asset? Because that is going to generate revenue for the bank, that is going to generate interest for the bank, profit for the bank. So this is an asset. If the bank does investment somewhere, that is also an asset because it will give you return. Money at call and short notice is also sort of a loan. What is money at call and short notice? Call money and short notice money, for example, call money is money given overnight, for 1 day, 2 day. That sorry, that is your call or short notice money. Okay, at times what happens is big firms, for example, let's say a big corporate, the salary date is approaching on 28th, the corporate's bill is pending from the client and it is yet to be transferred to the company, but the company still wants to pay to their employee on time. So they use the facility of money at call or short notice money from the banks, wanting money only for 3-4 days, 1 day, 2 day, overnight. An immediate requirement for a very short period of time is money at call or and short notice money. Now here also the banks will charge interest to the company, whoever is borrowing the money. So this will also act as an asset. The correct answer here is deposit. Deposits is not an asset. If I am depositing money with the bank needs to return that to me, and this deposit is generically written, so it includes demand deposit as well. If I have demand deposit in the bank, I deposit right now, half an hour later I want it back, I should get it back. So remember I said rupees 100 as fixed and rupees 100 at demand deposit. So demand deposit money cannot be utilized for giving loan. So deposits will not be included in the assets of commercial bank in India. I hope that's clear. Moving ahead, capital adequacy ratio. So now we did the capital adequacy, let's say capital asset or what, some concept we already did. It's a similar concept or it's the same concept. Sorry. Capital adequacy ratio, CAR. We did that. So now they are talking about that exact same thing, that is capital adequacy ratio. Is the amount that the banks have to maintain in the form of their own funds to offset any loss that the banks incur if the account holders fail to repay. Risk. You have given loan, some loans may not come back. So what is the amount of risk you have? X amount. How much capital do you have? Let's say Y amount. So you have Y amount of capital to take care of X amount of risk. So capital adequacy ratio is what? The amount that the bank have to maintain in the form of their own funds to offset any losses that may incur if the account holders are not repaying. So this is correct. CAR is decided by each individual bank. Just imagine if you leave it on the whims and fancies of individual banks to decide, they may say, okay, I will keep it as 0. So it is not for the banks to decide. There is a regulator, that is RBI, right? It's the job of the regulator. Individual banks will not be deciding it. So the correct answer is option A, 1 only. Which one of the following best describes the term merchant discount rate, sometimes seen in news? I have included certain topics like this also, which you will not find anywhere in the book. So it is important to discuss this topic. What is merchant discount rate? So if you see, actually few years back, the let's say debit cards, let's say 10-15 years back, debit cards were not that common. ATMs were not that common. Payment through debit card was not that common. Online payment was not that common. Digital transaction, net banking was not that common. So 15 years back, when you would go to a shop to purchase anything, any good or service, let's say you have gone out to purchase a shirt. What happens is the shirt is of, let's say, 1000 rupees. Now you bring out your debit card and you're about to pay with the debit card to the shopkeeper. The shopkeeper would have told you at that time that sir, madam or XYZ, whoever it is, okay, if you pay through the debit card, so this rupees 1000 shirt would cost you rupees 1025. That means 2.5% extra. Are you okay? If you're okay, let's pay it. You say okay. So what happens is 1025 is charged, 25 rupees additional is charged. This additional money is nothing but the merchant discount. Now the word is discount, but it is not a discount as such. It is an additional fee which you are paying. Why were you required to pay the fees? Because banking system, net banking system, ATM cards, ATM machines, digital transactions were not that common, very less frequently used, but still you have to maintain an entire ecosystem. To maintain that you need some money, right? So that money is being charged to the merchant, and that merchant is transferring that to you, and hence you are required to pay that additional amount, and that additional amount is nothing but the merchant discount. So knowing that, let us solve this question. Which of the following is merchant discount? Incentive given by a bank to merchant for accepting payments through debit cards pertaining to the bank. Now it's not an incentive that is given by the bank to the merchant, rather the bank is asking more money. So do not get confused by the term discount. So this is not the case. Amount paid back by bank to their customers when they use debit cards for financial transactions for purchasing goods and services. No, again it's a charge which they are incurring on us. The charge to a merchant, yes. The charge to a merchant by a bank for accepting payments from his customers through the bank's debit card. Since the merchant has accepted the payment from the customer through the bank's debit card, so that merchant would be charged. Remember, the merchant is getting charged, but the merchant is transferring that charge onto the customer. This is the correct option, but let us see the last one. Incentive is given by the government to merchants for promoting digital payments by their customers through point of scale machines and debit cards. No. So it is neither an incentive, it is nor the amount that is paid back, it is nor incentive anything. It is rather a charge, it is rather a fees that is charged, which is your merchant discount. I think this is a repeat question. Let's move on. Which one of the following statements correctly describes the meaning of legal tender, that is money? Legal tender money. So what is a legal tender money? Okay. The money which is tendered in courts of law? No. That's not, this is probably the worst option, very easily identifiable that this is wrong. The money which a creditor is under compulsion to accept in settlement of his claims? Yes. For example, if I take a loan from the bank, I cannot go and return. If I have taken a loan of 1 lakh rupees and I have to repay it, let's say, I cannot return 1 lakh worth of rice. I can do that, but then the bank has to accept it. But will the bank accept it? Of course not. Where will they place it? And banks do not deal in rice and trading and all these things. So banks cannot accept it. Banks can reject it. If the banks reject it, I can't do anything. But if I go and I want to pay the bank, the loan of the bank in Indian rupees, let's say 100 rupee notes, all 100 rupees note or all 10 rupee notes in cash, the bank cannot say, no, sorry boss, I will not take it, please transfer it online. Sorry boss, I won't take it, I want dollars. No, you cannot reject that because that is a legal tender. So the meaning of legal tender has come from this fact only, that if you have taken some credit for someone and you are about to pay it, the legal tender would be the money in which when you pay, the person cannot reject it or say no to that particular kind of payment. Then that payment is said to be done in legal tender. So it is nothing but the money which a creditor is under compulsion to accept, meaning they cannot reject it in the settlement of their claim. Clear? Other options are the bank money in the form of check drafts, no. Metallic money in the circulating in the economy, no. Which one of the following links all the ATMs in India? Now this is a very factual question. It is the National Payments Corporation of India, that is NPCI, which links all the ATMs in India. When the Reserve Bank of India reduces the statutory liquidity ratio SLR by 50 basis points, as in by 0.5%, which of the following is likely to happen? Now, this is a very logical answer. Now think of it. What is SLR? Statutory liquidity ratio is the amount that the bank is required to keep with themselves in the form of any liquidity asset, liquid asset, for example gold. So if earlier, let's say the SLR was X%, now it is X minus 0.5%. So SLR has now been reduced. So when SLR is reduced, that means what? That means that the bank will have more money to give out as loans, right? So when the bank has more money to give out as loans, let's see what will happen. India's GDP growth rate increases drastically, not necessarily. Also guys, in UPSC, whenever there is a use of the word drastically, be very careful. Generally these options would be wrong. Foreign institutional investors may bring more capital into our economy, not necessarily. So this is wrong, this is wrong. Scheduled commercial banks may cut their lending rates. This is possible. Scheduled commercial bank may cut their lending rates. It may reduce the liquidity to the banking system. It may drastically, again drastically what? No, drastically it will not reduce, plus it will drastically reduce the liquidity to the banking system. No, it is rather increasing the liquidity in the banking system, because now the banks have more money to loan out. So this is also wrong. So the correct answer is this. Scheduled commercial banks may cut their lending rates. Why will scheduled commercial banks may cut their lending rates? Now they have more money to play with. So with more money they can make more profits even if they give at low interest rates. Hence this is the most appropriate answer. Okay, let's move on to the next question. The question states, what are the facility or facilities the beneficiaries can get from the services of business correspondents or bank sathi in branchless areas? So who are business correspondents? See, in India there are a lot of unbanked and underbanked areas. Unbanked areas meaning there are no banks. Underbanked areas meaning there may be a bank or two very far off. Okay, and may not provide all the instruments, all the services, very limited services will be provided. So that is the concept of unbanked and underbanked area. Whenever there is an unbanked or underbanked area, what happens is there would be less savings in the bank because the banks are not close by, very difficult to take loans and all those stuffs, all those things may happen. Now either the bank can open branches over there, but that would require a complete physical infrastructure, the employees, everything. But instead the government came out with a concept of bank sathi, that is business correspondents, wherein these bank sathis will visit that particular region one fine day and visit door to door and see who needs what and what is required and do all those activities and come back. So it is like banking coming to your doorstep, bank coming to your doorstep. That is the idea. Now knowing that, let's solve the question. Which are the facilities the beneficiaries can get from the services of the business correspondents? It enables the beneficiaries to draw their subsidies and social security benefits in their villages. Yes. It enables the beneficiaries in rural areas to make deposits and withdrawals. Yes. So when you go to the bank, you can do these things. It's just reverse. Now the banks are coming to you. So again, you can do all these things. That's it. The things which you could do while going to the bank, now you could do by the bank representative coming to you. So the functions remain the same, the manner is just different, that's all. If the RBI decides to adopt an expansionist monetary policy, what is expansionist monetary policy? Spending more money in the market, that is expansionary, right? Reducing the interest rate so that more and more, when you reduce the interest rate, the money becomes cheaper. Because you can get money at a cheaper rate of interest as loans, right? So when money becomes cheaper, more and more people would want money and spend it. So you are spending more. So expansionist policy, as in the interest rate or the repo rate is going to go down. So if the RBI decides to adopt an expansionist monetary policy, which of the following would it not do? Would it not do? Not. It will not do. Cut and optimize the statutory liquidity ratio. Cut and optimize. It will do that. It will cut the statutory liquidity ratio. If earlier it was X, it will reduce it to X minus 0.5, so that more money is available with the bank. And we saw if more money is available with the bank will reduce the interest rate, more money gets available with the people. So it will actually do this. Okay, so statement 1 is wrong. Since statement 1 is wrong, this is wrong, this is wrong, this is wrong, and this is the right answer. But still, let us see the other options. Increase the marginal standing facility rate. Yes, it will not do this. Why? Because marginal standing facility rate affects the rate at which the banks give you loan. If marginal standing facility rate is high, the rate at which banks will give you loan will be high. So if RBI increases the marginal standing facility rate, then the banks will start giving you loan at a higher rate. Since they will give you at a higher rate, money will become costlier and you will want less money and less spending will be there. So this is something which the bank will not do. Let me change this. This is 1, this is 2 and this is 3. Statement 1 was wrong, so only this was left. But still we are looking at other statements. Statement 2 is correct. 1 was wrong, 2 is correct. 3 has to be wrong, but let's see. Cut the bank rate and repo rate. Now, cutting the bank rate and the repo rate. This also it will do. I said that it will bring down the repo rate. Right? And here also it is saying cutting the bank rate and repo rate. Yes, this will also do. But the question asks what it will not do. So it will not do this particular thing. Rest 1 and 2 it will do. Only statement 2 it will not do. Hence the correct answer is option B, 2 only. Now, Indian government bond yields are influenced by which of the following? Actions of the United States Federal Reserve. Okay. Actions of the Reserve Bank of India, okay. Inflation and short-term interest rates, okay. All of them. Now let us understand how all of them. Okay. So let's start with the easiest one. Inflation and short-term interest rates. Inflation and short-term interest rates. If there is inflation, the bond yield will be impacted. If the bond yield, let's say the bond yield was 10%. Interest rate is inflation is 15%. Bond yield is already impacted of the bonds which are already sold. That's point number 1. Point number 2, the new bonds which will be brought in would be at a higher interest rate. So inflation would affect the interest rate of the bond. Actions of the RBI, Reserve Bank of India, of course, if RBI increases the rate, so rate of all the financial instruments should generally increase. If the RBI increases the repo rate, all the instruments rate will increase, be it fixed deposit, be it loans, be it personal loans, home loans, vehicle loan, etc., anything, be it savings account. In savings account also you get some amount of interest, even that will increase. Be it bond, so every rate will correspondingly should increase. It need not generally increase because sometimes the banks may not do that, because then less people would want loan. But generally the banks also do it. The banks also increase the rate because they would also be getting at a higher rate from the Reserve Bank, so they will also increase the interest rate. So when this increases, all the instruments rate will increase. So this was correct, this is also correct. Now, the first one, actions of the United States Federal Reserve. This will also affect, not directly but indirectly. How will it affect? If the Federal Reserve is providing very high interest rate in USA on the bonds or on any other deposit, people would want to invest in US. So money from India and every other country will fly away to US, right? And less number of people would want to be depositing the money in India and other countries. So the instruments would want to become more attractive for the customer to attract them to back to India, right? So that is how it affects. Secondly, if the federal bank reduces the interest rate. So less and less people would want to invest in USA, and the money will come out from USA to India and other countries, and more money will be chasing instruments in India. So even if the bond yield is less, still people would invest more in India, because USA the rate is even lesser. So whether the USA Federal Reserve increases or decreases, it is going to have an indirect impact on Indian financial instruments, and bond is one such instrument. So hence all are correct. The money multiplier in an economy increases with which of the following? Increase in the cash reserve ratio in the banks? No. If cash reserve ratio increases, that means more money the banks have to keep with the RBI, so less money in the market. Increase in statutory liquidity ratio? No. Again, this is the amount they have to keep with themselves, so less money in the market. Increasing the banking habit of the people? Yes. Because if you keep the money in the rice container at home, it's not in the market, it's not going to multiply, it is going to stay there, it is not going to change hands. But when you put it in the bank can give out loans, it will change hands, it will have a multiplier impact. Increase in the population of the country, just by increase in population need not necessarily increase the money multiplier effect. So the correct answer is option C, that is increase in the banking habit of the people. Next, in India, the central banks function as the lender of last resort. We saw this concept. Lender of last resort usually refers to which of the following? Lending to trade and industry? No. Providing liquidity to the banks having a temporary crisis? Yes. So 1 is wrong, 2 is right. So if 2 is right, this will also go away. Let's look at 3. Lending to government to finance budgetary deficits? No. The RBI can do that, but because of this, it is not known as lender of last resort. It is known as lender of last resort because it provides liquidity to the banks having a temporary crisis. So the correct answer is option B. Now, consider the following statements. Tight monetary policy meaning the repo rate going up, so that the policy is tight, so that money is costlier, so less money people would want to spend. It's a contractionary policy of US Federal could lead to capital flight. So if tight monetary policy is there, that means US Federal Bank has increased the repo rate, so the returns on US financial instruments would be higher. So money from India and other countries would fly back to USA to be invested there. So this is correct. So this option is gone. Capital flight may increase the interest cost of firms with existing external commercial borrowings. Now when the capital is flying away, right, but you had already taken loans previously only, right, and the capital is flying away, so less capital is available, so of course the interest rates would go up. When repo rate goes up, every thing generally should go up. So this is also correct. 1 and 2 is correct, so this is gone. Devaluation of domestic currency decreases the currency risk associated with external commercial borrowings. It says devaluation of domestic currency, meaning earlier if $1 equals to rupees 50, now $1 equals to rupees 100. It is saying that devaluation of domestic currency decreases the currency risk associated with the external commercial borrowings. No, it increases the risk. Let's say you borrowed $1. If there was no interest rate, you have to return the $1. How much will you return? 50 rupees. But let's say you borrowed $1. But after a while the currency depreciated, Indian rupee depreciated and $1 became 100 rupees. So now if you have to return $1, you will have to return 100 rupees and not 50. So due to the depreciation of the currency, it is devaluation of domestic currency decreases the risk associated with external commercial borrowings. No, it increases the risk associated with ECBs. ECBs are external commercial borrowings. So statement 3 is wrong. The moment 3 is wrong, the correct answer is A, 1 and 2 only. Okay, so this was your banking and the topics, the concepts related to it, as well as the previous year questions related to it. In the next section, we will be looking at financial market, stock market. We'll be looking at different sectors of economy, industrial sector, service sector, agriculture sectors. So in the coming sessions, we will be looking at the remaining part. Stay connected with Legacy IAS. Thank you.